So the S&P 500 is hovering around positive territory for the year, helped by the weekend truce on tariffs between the U.S. and China. So let's get some more perspective on that. Sam Stovall joins us now. He's chief investment strategist at CFRA. Sam, thanks for joining us today.
My pleasure, Marilla.
Why do you think we're seeing a bit of wavering today in the S&P after the strong start Monday and Tuesday?
Well, I think that the surge on Monday and Tuesday was so great, also turning around the sentiment of investors that right now they're sort of wondering if the market is overbought at this point and whether it is due for a short-term digestion of gains. But certainly we have been seeing investors rotate back into those groups that had been beaten up the most during the sell-off.
Do you think investors have just been getting a little too optimistic or waiting for something to be optimistic about?
Well, I think there were an awful lot of investors who had to cover their shorts. In a sense, they had sold stocks they did not own in order or hope to buy them later at a lower price. And then when Monday came along, they had to cover those trades quite quickly, pushing the market higher. So right now, I think what investors want to do is to wait and see whether companies will be improving their earnings as the year progresses, because we went from 2025 estimates of 13% down to 9% at the beginning of this reporting period, and now we're at about 7.2. So we have a long way to go to recover the earnings expectations so as to not see the valuations skyrocket along with the prices.
Okay, so let's talk about under that sort of light. Do you think the worst is behind us for businesses now that we're seeing some of that movement on the trade war?
Well, I think that there's a good likelihood. History would say, however, be careful, because 2 out of every 3 bear markets since World War II started with a correction, meaning a decline of less than 20%, that then recovered to the 200-day moving average and slightly above, as we have done so far, only to then turn around and set an even lower low. Also, the NASDAQ 100, which recently jumped 20%, implying in a new bull market, 5 times since its inception, we have seen fake outs, meaning we've had 1 or more times in which the index rose by 20%, only to then turn around and set an even lower low before the bear market was over.
Okay, so fake bottoms. What is your prediction then for the S&P 500 for the rest of the year?
My prediction is we'll see the S&P work its way up to 6050, 6050, and I might find that I'm lowballing that at this point. So really, I think investors, if we are not going to be seeing a dramatic slowdown in the economy, we really are not forecasting a recession. If that were to come to pass and that we get an improvement in earnings, then certainly the old highs will be challenged.
Okay, so let's talk about sectors you see that are going to work towards a recovery. Obviously, tech, we know there's been bounce back in tech, but what else do you see moving forward?
Well, as you know, I'm a student of history, and I start by looking at history, but realizing that, like the singer of the national anthem, sometimes it forgets the words. So what I do recognize is that the 3 worst performing sectors, communication services, consumer discretionary, and technology, which were beaten up the most in the decline, are now advancing an average of 24% versus the market's 18% rise since April 8th. And if you look at the 10 worst sub-industries, they're up 34%. So such areas as automobile manufacturers, independent power producers, semiconductors, and passenger airlines have all done very well. And we do have buy and strong buy recommendations within each.
Let me ask you as we move forward, because you talked about guidance and the fact that it was either revised or pulled for many of these businesses. Do you think they'll feel comfortable enough to reissue guidance they can stand by over the next couple of months that will guide them through the year?
If they feel that the tariff situation does not change on a weekly or a daily basis as it has since Inauguration Day, then I feel companies will be more willing to offer guidance. Right now, they've either pulled guidance or they sound like two-handed economists saying on the one hand this, but on the other hand that. So if we can see a settling down of the tariff situation, know what to expect, then I think companies will be more willing to offer some guidance.
Are most projecting or planning, you think, around the idea of a 10% tariff at the height for some countries?
Yes, I think so. Our Washington Analysis Political Strategy Group does believe that most countries will be seeing that 10% tariff level. Also, what we're expecting is not really broadly based trade agreements, but rather little pockets that the U.S. can then tweak if they wanted to make some improvements to, in a sense, our own side. So I think what we're finding is that the administration wants to continue to be in the driver's seat by having the opportunity to make some tweaks along the way. But yes, I think 10% seems to be something that companies can manage, as well as push forward some of those costs onto the consumers.
What do you think of a mini trade deal as opposed to a longer, deeper negotiation that leads to something that would be more extensive?
Well, personally, I'd rather that something longer and more stable were to be enacted, because then you could focus on other areas of the business rather than having to worry about whether the trade situation is going to be changing on a month-to-month basis. If we realize that 40 to 45% of the revenues for companies in the S&P 500 come from overseas operations, that makes for a pretty challenging planning environment. So I think that longer term, most companies would much prefer to be able to know what lies ahead.
Okay, so I'm sure the next few months will give us some indication of which way we're going. Sam Stovall, good to have you on the show, sir. Thanks very much for sharing some of your time.
My pleasure. Thank you.